Welcome to INN's coverage of PDAC, which runs online this year from March 8th to 11th. You're about to watch my interview with Frank Holmes of U.S. Global Investors. It was filmed on February 25th, and in the interview, Frank talks about what's going on with gold, as well as what investors should know about cryptocurrencies like Bitcoin. We'll be posting all of our PDAC content right here on our YouTube channel, and we encourage you to follow along and enjoy. I'm Charlotte McLeod with the Investing News Network, and here today with me is Frank Holmes, CEO and Chief Investment Officer at U.S. Global Investors. Thank you so much for being here online with me today.
It's great to be with you, Charlotte.
It's great. And today we're going to start off by talking about gold. We really haven't seen too much momentum in gold this year, and I know some people are feeling a little bit confused about why that's the case when it seems that there's so many underlying drivers that are positive. So let's start off by asking, why isn't the gold price moving more right now?
Well, a big part of that gold move last year was in the first 6 months of the year. And the previous year, we had it in the first 8 months, and then it faded off. And a big factor in what's called sort of the autocorrelation between a 10-year government bond yield and gold. So when the 10-year government bond yield is falling, the price of gold is going up. And when the 10-year yield is rising, the price of gold is going down. So last year, interest rates were over 2%. This time of year, they crashed to 50 basis points. And as they crashed and more negative news was taking place on COVID, gold took off because the money printing presses were taking place. MMT, modern monetary theory, was being practiced differently, but extensively and massively by the G20 countries. Print, print, print. The US was a 40% increase in money supply and negative interest rates. That propelled gold. But we saw in September, the beginning of September, the 50-day moving average for 10-year yields started rising. And when that happened, you can see August, September, gold is coming off because there's always this parity trade between gold and the 10-year government bond yield.
All right. Now, with all of that in mind, what do you see gold's price potential as being in 2021 is the year we're in now. Where are we going and how do you think we're going to get there?
I'm very, very bullish. You know, gold is an incredible asset class. If you look at the first 20 years of this century, gold was up 16 of the 20 years. 80% of the time, gold was positive. And gold was 250% higher performance than the S&P 500. So not having gold and diversifying in your portfolio is probably a bigger risk. And having a 10% weighting at a minimum and rebalancing once a year has proven as an asset allocator a great way. Now, if you're a tactical trader, you have to look at that 10-year government bond and the 2-year government bond and real interest rates. And are they going positive or negative? It's because you're trading much more. But as an asset allocator, gold is a great asset. Now, going forward, these governments aren't stopping printing money. They're just going to redirect where they're going to spend money. They're going to be spending money on infrastructure, but green infrastructure. Europe talk about €1 trillion. The US is over $1 trillion here. The President Biden's pushing. So you have to turn around and take a look at, well, who would be the biggest beneficiaries of a big green energy infrastructure push? Which sectors of the economy would do well? And they all need metals. They need metals. And mining, exploration dollars, no matter what the commodity, has an all-time low. And you're going to see it continue to be this way, means we're going to have higher commodity prices. Gold's at a 9-year, sorry, not gold, but copper's at a 9-year high. Gold made a new high last year. So I think that we're going to see much stronger and higher prices. Silver have outperformed gold. Still, a long-term silver still way behind on that relative basis if you do that gold-silver ratio. But I think silver is so special because you need it for solar panels, and there's going to be a big spend for solar panels. Then you want to own silver because solar panels need a lot of it. 20% of silver demand is for solar panels.
Right. So definitely a lot of metals optimism right now. And speaking of silver, this is our first time speaking this year, which means that I have not yet heard your thoughts on the very interesting situation surrounding silver, Wall Street bets, Reddit, everything that's going on there. I don't want us to get too deeply into it, but I do wonder what you think that tells us about the state of investing today.
Well, I think it's really important to have this operative word is called price discovery. And if you just have a bunch of tunas and whales making the prices, you really don't have liquidity and you really don't get a reasonable price. When you have a complete ecosystem where the ocean is vibrant with life, it's not on a beautiful sandy beach in a lagoon. It's where the coral reef is and the waves are crashing. You get a complete ecosystem. So the ecosystem has expanded dramatically. And what's interesting for me is under President Trump, who was just a lightning rod for negative narrative, did something no other president did. Every morning looked at his hair and what's the stock market doing? And all these kids stuck at home, they all started looking at the stock market. It's interesting because it's contrarian thinking. And now he's gone, but the enthusiasm and the interest as a stock market as a precursor for growth and wealth and creation and travel, etc., it was a big game changer. In the 90s, me as I'm a baby boomer, in the 90s, my age, my group discovered the stock market. They discovered mutual funds, and they also discovered tech stocks, and things went for a 10-year massive run. And then it started to just never fell. It never really came back to its vibrant life. New rules and regulations made it more difficult for capital formation, discouragement towards investing. These kids now have lit up the Christmas lights. They're all in there. They're trading. And then we had last year sports. Sports came to a halt. Guess was a big part of sports for Vegas? Gambling, betting, casinos were shut down. So what did all these predominantly baby boomers that were speculators and gamblers at these casino tables, they all turned to stocks and stock options. And then you had Portnoy with the Barstool all of a sudden become with 7 million followers and a huge influencer on good speculative bets because there was no sports betting. Well, that allowed for price discovery. The millennials came in and started buying My Jets ETF. I mean, this is an ETF that's trading 35,000 shares a day, $3.5 million. Now it's 3.5 billion and trades 3.5 million shares a day. I mean, it's spectacular. And they started buying, even though Buffett got out of it. And after Buffett was out, we were able to get the data at the time. 25,000 Robinhood investors made 50% on their money. That's a big number. So they're saying they're all stupid, they don't know what they're doing. I disagree. I have found in my research that many of them were former working at Citigroup Bank. They worked at other banks. They have financial expertise. They traveled all over the world. They're much more global. So they're stuck at home and they knew the best places, best airplanes. They started speculating. And what's happened is that in the last three big economic global crises, a year later, the airlines are up 80 to 120%. So that's why they were speculating. It was wise and rational. They were not stupid. And now we're seeing now the second leg. So I think it's very, very healthy to get the speculation that's come in because it's young people. My age shouldn't be speculating like this. No, but young people are speculating and they want to all be in the new Apple and the new technology. And you've seen this enthusiasm go into Bitcoin and Ethereum and mining, crypto mining stocks, because that's the future. And these social media platforms, they're game changers because they're democratizing the capital markets. Now, this negative run at Citadel, well, Citadel is basically the recipient of all the individual pro traders when I got in the business, had to put up capital for the risk of a spread. Now it's done with quants. And so you actually can go at Robinhood with $500 and trade stocks, no commissions. And on that toolbar, they're the only place to have a toolbar that has gold. It has Bitcoin. You can buy those. You can buy them in fractions. And that, to me, is a wonderful part of price discovery.
Right. And, talking about popular investments or speculations right now, definitely we have to go back to Bitcoin, which I know you're involved with Hive Blockchain. You'll be able to give us some great perspective. What exactly is going on in Bitcoin right now? It's seen a lot of price momentum this year, both up and down. What's happening with that volatility we see there?
Well, whenever something is new and disruptive and innovative, you get huge volatility as more and more people start to adopt to it, and there's naysayers. So Bitcoin has the richest man in the world put up $1.5 billion, Tesla, Elon Musk, and you have Bill Gates suspicious about it and Warren Buffett, but you have all these things that created more volatility. If you look at the DNA of volatility, and every asset class, by the way, has its own DNA of volatility. The stock market is the same as gold. It's plus or minus 1% a day. But Ethereum and Bitcoin are 5 and 6% a day. And over 10 days, substantially greater. Tesla is the same as Bitcoin. So I find that most interesting. And the work I've done in looking at anything that's really a disruptive stock or industry like Amazon coming along, they're just, especially at the beginning of their growth cycle, very volatile. So I don't think it's that big of an issue. But remember, all those kids that play GameStop, and I call them kids because of my vintage. But what's really important is that those kids were buying at GameStop. They knew the business. Like my age knew Starbucks. Starbucks was a growth stock of the 90s and the past 25 years went exponential, but it was a real early growth stock of the 90s. That's where I went to get my coffee traveling all over the world. And what was interesting was that these kids would play these games, these video games. And if they were really good at them, they got digital money in that software and they could upgrade. And they didn't have to go to get $20 from their parents to buy something new because they were really good and they got paid for it, rewarded. Well, their brain's been wired for dopamine, and that dopamine relationship is so important. So digital money, crypto, Ethereum, it's easy for them to relate to. It's easy for them to relate to GameStop. It's easier for them to relate to Tesla. So I think that's just part of that overall economic switch and change that's taking place.
Right. And would you see the volatility as, is it kind of a growing pain and we would see that even out at some point in the future?
Oh, it takes 10 years, maybe 15. But for that big 10-year run, if you take a look at Amazon, what it's done in the past 23 years is phenomenal. But the volatility has slowed down to a certain degree because of its sheer size, but still very volatile, but nothing like Tesla. And look at ARK ETFs. I mean, that goes from $1 billion to 3 billion, 3 billion to 15 billion, and then to 60 billion. And then it has the big record, $1 billion that goes out in a day. I mean, this is, so all that money going into those ETFs, which millennials have discovered is a way to trade stocks. And we've seen that success with our GoAU, which is a quant-based picking gold stocks, like we've seen with our JETS ETF. Phenomenal liquidity has come into the capital markets. And what's really important in the institutional world, if you have all these minnows with price discovery, like picking a price, then bigger money comes in. And then more minnows come in, and then bigger money comes in. So my biggest investor in JETS ETF are the insurance companies. Remarkable. So it's so important. We're going to see this more and more in this growth. Now, what happened under Obama for me was interesting because everyone was so negative on Obamacare, and you would just think the worst industry to be in were in healthcare stocks. Not true. Bad news is good news because the healthcare stocks went up at a 80% compounded rate. I mean, it's phenomenal growth during that time period. So when we have a hurricane hit Florida, the insurance stocks all fall, but housing stocks go up. So as an investor, as an active mindset, you have to say, okay, this is negative, and yes, it is. Where is there an opportunity? Who is going to be a solution to this problem? COVID comes along, Amazon hires 100,000 people. You can see that there was a huge need. That stock goes on a tear. So that's the magic of free markets and capitalism. And it's so great. Now we have SPACs. are growing and proliferating. Another dynamic part, along with these active ETFs that are growing substantially. I'm very excited. And President Biden doesn't appear to be, I think he didn't win by a landslide. So he's got to be very cautious not to upset that swing vote that's in the middle. And if the stock market all of a sudden crashes because of bad policies he has, well, that'll hurt the 2-year term, and that will hurt the next 4 years. So I think we're going to have a centralist government. And I think it's to be very bullish. And we've had all these millennials basically embracing free markets and capitalism. It's a double win.
Right. And as we continue talking about cryptocurrencies, I think by this point, everybody's heard about Bitcoin, whether they like it or not, might be a different story, but they've heard of it. What other cryptocurrencies should we be paying attention to? I know you've been mentioning Ethereum a little bit. What ones do you have your eye on?
Well, I have a little 1-minute video for investors to understand the difference between Bitcoin and Ethereum. And that's important to recognize because Ethereum is a smart contract. And the smart contract is very important because it is the backbone for what I would say was the bottom of the crypto winter. What we had at the very peak a couple of years back in 2017, when they came with the futures market, was able to push down Bitcoin from 19,000 down to 3,000. And then for the next 14 months, nothing but negative news, negative news, negative news. And at the very bottom, JP Morgan comes out with their crypto stablecoin. Guess what? It's back in the backbone of the Ethereum algorithm. So as it grows and as stable coins grow, they use more Ethereum. Very bullish for Ethereum. And then we have this proof of stake, which all of a sudden people donate to get an income on their Ethereum. That Ethereum, $5 billion of Ethereum gone. So we're seeing a shrinkage of the supply. And the last real big word you're going to hear this year is called DeFi, decentralized finance. And there's going to be so many hot new stocks like a tech boom that's going to be in this space. And usually and most often they use Ethereum. Well, this is great news for Hive because Hive is the only blockchain mining company mining both Bitcoin and Ethereum. And I think that's why last year Bitcoin was up 300%, far greater than gold, and Ethereum was up 470%, and Hive was up 2,500%. And then from there, it still doubled. So Hive is liquid with cash. We've expanded dramatically our footprint for mining Bitcoin, and we are the biggest and only player if you want to play Ethereum. And we have tens of thousands of investors that are still afraid to go to an exchange to buy Bitcoin and Ethereum. So they use Hive as a proxy. And so we go up and down by the hour with what Ethereum Bitcoin's doing.
Okay. And I think just to bring the conversation back around to gold and the other precious metals, definitely we here at INN have an audience that's very focused on gold. And I want to ask you about, and I think I know the answer to this question, but can gold and cryptocurrencies both have a place in an investor's portfolio? And additional question on the cryptocurrencies, is now the time to be getting in with prices so elevated at the moment?
Well, when you look at a disruptive sector, you have to go and your readers go to Google and type in Metcalfe's law. Metcalfe's law explains that as the number of wallets and smaller investors take just small pieces of Bitcoin and more people, then it starts to grow exponentially. It's a very well-defined model to explain this spectacular growth. And the adoption cycle is measured by how many wallets are coming in, not how many dollars are going in, by the wallets. And when I saw that with my JETS ETF, as more and more people came into it, then all of a sudden the noise and the information, the flow grew and grew, and then bingo, off things went. So I think Metcalfe's law is very significant. Bitcoin, remember last year did a halving. You know what happened to gold if there's 100 million ounces of gold produced every year, and tomorrow it's 50 million ounces only? Gold would go to 10,000. It was only rational that you would see Bitcoin take off. So now with gold is the fourth most liquid asset class in the world. You cannot wear Bitcoin as jewelry. You cannot use your Bitcoin unless you have electricity. So you're going to need copper and you're going to need other metals. And last week when we had the blizzard and snowstorm and power outages in Texas that impacted millions of people, guess what? Bitcoin doesn't work with electricity, just like the heaters didn't work. So gold always works. Once you can wear it as money, you can wear it as jewelry. So, and gold is going to always be in central banks as a reserve currency. It's expensive. It's difficult to mine. It's much faster and easier to print money than it is to mine and get an ounce of gold. So gold's not going away. And I have seen over the past 20 years, the explosion by the G20 central bankers in applying MMT, modern monetary theory, which is giving out money to different sectors of the economy, and by the central banks coming in and buying ETFs to impact sectors of the economy. Japan central bank owns 15% of their stock market. Swiss, they own more than that, but they also buy individual names. They float this money, no one buys it, they create it, and they buy Microsoft, they buy Apple. It's really a shocker to see all of a sudden what's taking place. They're buying real assets. And I think that gold is always going to be a key component, but gold fear trade is only 40% of demand, 60% is love. And as we're still continuing to see the rising GDP per capita for China and India and Southeast Asia, then we're going to continue to see strong demand every time gold corrects. Bitcoin and Ethereum is a different audience. They both should exist in a portfolio as alternative assets.
Perfect. And I think we came full circle there, what with needing the metals if you want to have electricity for Bitcoin. So that's great. As we finish up, are there any final thoughts that you would want to leave investors with for 2021?
Well, the biggest thing I share with them is whatever your age is, that age is saying is what you should be invested in short-term income and growing dividend-paying stocks. That's what you should focus on. So if you're 25, Charlotte, then only 25% should be in those asset classes, and 75% should be in more risky growth stocks. And that would include Bitcoin, Ethereum, a greater exposure. So in each year as you get older, you should just tail back and cut back and rebalance your portfolio. I think that's the biggest, wisest part. And in that whole thesis is 10% minimum should be in gold-related assets, and you should rebalance once a year to maintain that 10% weighting.
Okay, well, that's a very practical tip. Thank you for ending on that note. Great to have you on as always to talk.
Well, lots of health and wealth creation for 2021.
Thank you so much. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Frank Holmes with U.S. Global Investors.